Okay, good afternoon, everybody. Bobby Piton here with Preactive Investments, and I'm going to discuss where do we go from here in the market. So, hello, Jose. Hello, Jules. Good to see you. I know there's been a lot of people that have been asking about what we should do. I have a lot of clients that have been asking me this question. Actually, this question has been recurring for quite some time, this whole year, and actually, you can probably even go back a little further because there's been a tremendous amount of press in this country about how everything's going to collapse. Now, it's very tough to know when the end is coming because the end has never come, right? So it's one of those things where we've heard this doomsday scenario in the U.S. equity markets for a very long time. Now, keep in mind, at various points throughout U.S. history, especially in the past 20, 30 plus years, we have had pretty severe corrections. We've had the 87 crash. I remember the Russian bond debacle. It was actually right when I became a portfolio manager, folks. So back in 1996, right after I became a portfolio manager, the Russian bond debacle, where Russia defaulted on their bonds, caused a bunch of things to unwind in Asia. It caused tremendous stress on the banking system in the United States. Everything got absolutely beat up pretty good. And right after that, everything just took right back off. And so I don't know, nobody knows for sure what's going to happen with regards to the overall market direction. But what we can do, because everything is very difficult to decipher, we want to try to make the best decisions with imperfect information. Now, what information do we have that we can, try to trust, try to believe during a time when the government is clearly misleading us? I think everybody knows it from just living in the real world. You can see inflation is very real, right? It's very real when you go to the grocery store, you go to the gas pump, you look at your bills. Inflation is very, very real. And this deficit spending, whereas I do think some of it is fictitious, there is definitely a component that is very real. So maybe instead of the budget deficit being $3 trillion, right, which is the equivalent of there's 125 million people working. So 125 million times $10,000, folks. Okay, so times 10,000 is 1.25 trillion. So if every American received $2,000 a month, $2,000 a month is what the budget deficit right now is in the United States. That's what they're saying. They're saying it's 250 billion with a B per month. That's what they are forecasting for our budget deficit. Well, 250 billion, so 250,000 millions per month works out to be $2,000 for every worker in this country. Full-time equivalent, that is. When I say the phrase workers, I'm speaking about it from the standpoint of people that are, like actually working full-time equivalent hours. You work 10 hours, you're a fractional worker, right? Something like, I guess, like a fractional voter. But, so this is the deal. And so with that backdrop, you have all this crazy spending. You have the Federal Reserve that is financing this crazy spending through printing of money. And then you have all this money flowing in to where companies are really making more money. This isn't fictitious. These companies are generating record profits across the United States economy, all the publicly traded companies. And so, the question becomes, where does the stock market go from here? So I know I've kind of covered a bunch of things, and I'm just trying to give you guys, everybody, a backdrop. We have the pedal to the metal on fiscal policy. That's the government spending. Then we have pedal to the metal on monetary policy. That's the Federal Reserve printing. And then we have a situation where we are decoupling. I do believe, as much as it may not feel like it, right, because of who's in the White House, I do believe the United States is decoupling from China. I do think that is happening based on data. Not this isn't just my bearish stance on China and my dislike of the CCP and anything communist related. This is based on facts, and the facts are some of this inflation pickup in the United States might be the result of us starting to rebuild our supply chain in the United States, and that's what's putting pressure on all these commodities. Commodity prices. Some of it is the government is pumping all this money and adding all this fiscal stimulus, adding all this monetary stimulus, possibly to fund and finance the rebuilding or resurrection of our manufacturing capacity on the U.S. soil. Now, keep in mind, there's 3,100 or so counties in America. Each one, during this whole thing with China, the past 20 years, we've probably had the equivalent of 10 to 20 factories closed down per county in America. Now, that's a tremendous amount of loss of labor, and that might be coming back online. And so let's look at the math. If there's a function of say 50 to 60,000 factories shut down in the United States, or an average of one per county per year for 20 years straight. That's another way to look at it. One loss of a factory in each county in America every year for 20 years straight. That's how many we lost since China entered the WTO in December of 2001. So now, what is the big deal, Bobby? We're a service economy. This is what I hear all the time. We're a service economy. What are you worried about? We don't need to make things. We could send that out. And well, here's the reality. People in manufacturing make about 20 to 30% more than the average worker in the service economy. Probably upwards of 40 to 50% because of productivity enhancements that have taken place. So it is a big deal, because if the average person that actually produces things versus, I guess you can say someone like me that shuffles around paper and reads for a living, the more they produce, the better the economy is, because each job in the rest of the economy benefits from the manufacturing on U.S. soil. You need to get it ripples through the economy. There used to be, this saying, "What's good for GM is good for the country." I don't know if anybody remembers that, but growing up studying business history, that was a very popular phrase. What's good for General Motors is good for America. Well, General Motors at one point had 1 out of every 7 jobs in the entire U.S. economy tied to the supply chain of General Motors. Think about that. When cars were really taking off, General Motors, believe it or not, was a conglomerate auto manufacturer. So what they did is they had a business model. They were going to get super efficient, and this was during the time when they were really mastering the art of just-in-time. Not just-in-time came later in the 70s and 80s, but they were really mastering the art of how to produce cars efficiently. And so GM would buy these different brands, and they would literally restructure them. That's why GM has all these weird cars. You ever wonder about that? They have Buick and Cadillac, and what else is part of the GM lineup? I haven't even looked at GM cars in a while, but I know that they have a bunch of different brands, right? And the reason is Ford was the leader in the United States because of Henry Ford saying you can have any color you want as long as it's black, right? That was the color of all the cars, the Ford cars. And then GM said, you know what? We're going to make different color cars and different size cars and different brands of cars, and then they basically rolled up the entire industry. So why am I telling you all this? You're like, what the heck, Bobby? You're talking about where are we going? Are we going higher in the market or not? Why are you giving me a history lesson about business? Well, because the real reason why it's important to look at history, especially in our history as a nation, is I do believe we're in the middle of that transition. I think that we are returning back to our roots, and we're going to bring manufacturing back onto U.S. soil, and that the ripple effects we're seeing it already. We're seeing it in the form of higher prices. And this is frankly why I think we see a lot of the higher prices, is that you need to you have to really put in the liquidity into the system. Now, granted, I'm not privy to the data the Federal Reserve sees. Maybe some of you are out there that you can see exactly how many of these manufacturing facilities are opening up or being created nationwide. I guess one thing I should probably start looking at is the job postings, if they aggregate it by type of job. But with that backdrop, I'm trying to show why the growth in the U.S. economy, even though I do complain, folks, I'm well aware of the fact I complain that the growth of the economy isn't really 6 or 7%, because we took on 12 or 13% of debt to finance that 6 or 7% growth. I'm aware of that. I'm aware. I just want to make that clear. I know that it's not real growth. I do know that. However, when you price a security in the stock market, you have to look at not what you personally believe and know that that's bogus growth. You have to look at what shows up. What shows up for that company's bottom line? What shows up for that company and the earnings base of the company? How does it benefit the balance sheet? All these things need to be taken into account, because you'll get lulled out, or you'll get too defensive, and instead of looking at what should you do, what opportunities should you look for. So with that backdrop, I'm going to share my screen. Some of you might have seen this screen. I might have shared it maybe a week ago. It's just a simple NPV calculator that I put together. But I'm gonna share the screen of the NPV calculator. I'm gonna show you what it looks like with different types of stocks, and then I'm gonna also turn around and show you what are the estimates for. Let's look at what the estimates are for the S&P 500. And then, I'll give some advice about, look, where do we go from here in the stock market? And then theoretically, what you can be doing if you don't have somebody managing your money professionally. You can always contact me at Preactive. I know I'm not wearing my collared shirt today. I'm just wearing my more comfortable shirt, but I'm in front of a computer for 12, 14 hours a day lately. So I tend to wear slightly more comfortable clothing if I have to be wed to a computer. But anyways, you can always check it out at preactiveinvestments.com. But I'm going to share my screen now. Hold on a second. Okay, so you guys aren't going to see me. You're going to see the screen. So once again, this is the NPV calculator. I was just kind of going through and showing what a company looks like. Now, keep in mind, this is a standard NPV calculator. Anybody can do this. There's ways you can refine this. I don't show the world what I use personally. That's because it's my IP. so this, I'm just letting you guys know, this is a very simple model, but you add more value if you know how to look for edge through time. Okay, so that's the key. You got to know where to look for edge through time to pick up money sometimes that's available in the stock market. Okay, so I'm just gonna talk about a couple things, and then I'm gonna show you what it looks like with regards to the earnings estimates for the S&P this year. So right now, I'm going to expand it a little more. It still looks small on my screen, so I hope you guys don't think it's getting a little obnoxious now. Okay, so obviously this is the earnings per share, EPS. That's what that stands for. Growth rate. This is what the growth rate is over a 7-year cycle. EPS, we're going to strike at $1. Just for simplicity's sake, I want to show everybody what a multiple looks like. So when you hear the market is 20 times, right, 20 times earnings, that's what I'm going to calculate is what is the multiple. If you said, Bobby, what is the multiple? What should I pay for $1 of earnings if the market grows at 10% a year for 7 years, terminal growth rate of 0. It doesn't grow anymore once it gets to 7 years. And then we discount it at 8.67%. What is that worth? So if we look at that, that multiple is right here. Actually, it's going to be. It's going to be 19.91 times. That's what you're going to pay, folks. If you have confidence that you're going to grow at 10% a year for 7 years, you're going to price the market at 19.91 times earnings. That's what it would look like. Now, the example that I showed, when things got really ugly back in 2008 and 2009, I don't know if anybody remembers that, but I did this example here that the S&P traded down to it traded down to 666. That was the number it traded down to, and the earnings in 2008, believe it or not, were $60. That's what they came out at for the S&P 500. So the market traded down to 11.1 times earnings when that occurred. So when that bear market took place, now keep in mind, when everything is selling off, everybody's like, Bobby, we don't know where the earnings are going to go. And I would say, yes, that's why everything kept selling off, because people didn't have the confidence of where the earnings should go. And what I would say is the best way to deal with that stress is to figure out, well, what should that company, what should that industry earn over time when things aren't falling apart in the world, like when things get back to normal. And that's why I like to compute and construct what is normal earnings for a particular company and industry, and then create identify what does the valuation look like when it's normal. And that sometimes, keep in mind, folks, I just want to go to the camera here. When you come up with what's normal, so let's just say Walmart for 30 years, 40 years, they've earned about a 2.7% profit margin, like clockwork. I think actually going back to, over 40 years, since the 70s. So Sam Walton targeted a little less than 3 pennies for every dollar of what they sold. And they were at that rate for 40 years. It's unbelievable. It's one of the best run capital. If you think about Walmart as a capital manager, right? They manage human capital, the workers, and the supply chain. They own their own trucks and they own real estate. They deployed capital unbelievably well for over 40 years straight. Now, the Walton family happens to own half of the stock, over half the stock. But now it went from one little rinky-dink shop because the five and dime guy screwed over Sam Walton. That's what happened, folks. You should read his biography. It's pretty fascinating. And all of a sudden, you go to fast forward to today, it's doing over almost $50 billion of revenue per month. It's $560 billion, I think. And so why am I telling you that? Because along the way, the past 40 years, there's been wars, there's been oil shocks. Actually, I think Walmart is probably a little more after, after the oil shocks. Hey, Sean, I hear you. Well, Sean, help make Walmart go bankrupt by coming up with a better idea. That's the beauty of competition. So my job is not to judge who should go bankrupt and who should not go bankrupt. My job is to judge who's really good at what they do, and kind of place the chips where they are. Now, keep in mind, I do have a moral compass, but I don't think Walmart's violating any laws, willingly. I think it wouldn't have over 2 million employees if it was breaking a bunch of laws. That being said, I do stay away from companies that are in China by the CCP. Now, I understand Sean's argument. You're going to say, Bobby, you shouldn't be buying anything. You shouldn't buy Walmart because they're the largest customer of China in the United States. I know that fact, okay? But here's the deal, okay? Even though Walmart is the largest customer of China, they're not the ones that single-handedly made it so. That was a societal decision. And now we can argue as to, did we really make the decision? Were our votes being rigged this whole time? I'm not saying that, I'm not here to talk about that. But what I am saying is we have to play the cards we're dealt. So I do agree that buying local, I happen to buy a lot of my produce locally. And so that's what I like to do. I could taste a huge difference when I buy tomatoes from a local farmer, as well as corn, as well as peppers. There's no comparison to the grocery store, folks. So if you have the ability to buy local, even if it costs more, I highly recommend, if you can afford it, to do so. And I think that would be a wonderful thing for our overall economy. Is it would also lead to de-risking. I do think that we need to de-risk from corporatism in our food supply and every industry, frankly. But until those things happen, and they start to happen, I have to deal with the cards that are in front of me. So right now, the cards in front of me are, I'm showing you guys, this is what cards we have. So let's go back to this chart, okay? So 19.91 times earnings. So now I'm going to pull up. Let me take a look here. I'm going to go a new window here, and hold on, folks. I just want to. So I'm going to pull up what is the S&P 500. Okay. So S&P 500 right now, earnings. Okay. We're going to pull this up, and what do we have? We're going to go. So right now, year-over-year growth was 21% growth in revenues is what they're showing. Now, keep in mind, it was a little distorted because it might be we might have had a lower base because of the whole thing with the virus. I just don't want to say anything more than that with that because they get a little goofy on me. But now, if we look at Y charts here, now right here on Y charts, it's a service anybody can look at. I think they do a pretty good job with pulling the estimates and so forth. You can see the earnings that are being generated. And so, hold on a second. Is this the S&P earnings? I just want to make sure it's the right one. So let me take a look here. December, March. There's no way that they're earning 100, only 100. So let me take a look here. No? Hold on a second. So if we say the S&P 500 earnings, they're showing, this is a Schiller PE. Hold on a second. What do we got here? S&P earnings 500 is 128. That's not right. It is not that low. So I'm not sure why this is saying 128. Now keep in mind, folks, if you start looking at earnings, okay, you better make sure you have some kind of basis to do this, because you won't, if you garbage in equals garbage out. If you don't know how to confirm what the real earnings are of the S&P 500 or any stock for that matter, and you're making decisions punching it into an earnings calculator, you're gonna get yourself really badly hurt. So just don't do that unless you really know. I know that $120 is way too low. The earnings of the S&P 500 right now is not $100. The market is not 40 times earnings. I do know that much. And so I'm trying to find out why I'm trying to show you guys something that I can show you, because I don't have authorization to show you what I do use. And so since I don't have authorization to show you what I use, I'm trying to use something that is, is basically public, because I don't want to get into any trouble where I didn't show you guys something. This is not right. This is weird. Maybe they have a bunch of charges in it or something. So I don't know why Charts is doing that. But what I would tell you is that the earnings is, the earnings are closer to, hold on a second. Let me try one last thing. Hold on a second. Okay. So here we go, folks. I'm not sure why, but this is Y charts. I looked at this earlier. So we're going to look here, and I'm going to expand this. And I don't know why the other one is off, but you can see right here on December, March of 2021 is $45. Let me expand this some more. Hold on a second. So right here, you can see the S&P 500, $45.97. Okay. And then June, $40.80. And then September, 43, and then 45, 47. So right there, and then we can look out 1 year. And so 1 year estimates are approximately $198. So 52 plus this is if you quickly just round down the 50s, that's $2.35. We'll put that right here. That's up to $49.70, so $3.50. So it's about $49 a quarter, $196, $197 a share. These four numbers, okay? So $196 a share. This year, these numbers are about 90, 130, 175. So the S&P is 175 in earnings for 2021 and about 196 on a going forward basis. So let's see what that looks like. So if we say 196 and then 175, okay? So let's take a look. Okay, if we put in 175 as the earnings base, and we don't even look at what's going on, next year. Let me take a look here. If we go 175, the market grows at 10%, and it's discounted at 8.67%. What do we got? Let's take a look. What should the S&P be valued at? Okay, now the S&P, if you believe that 175 is what you should do and not forecast it forward, then the S&P should be worth about $3,484 right now. That's what it should be worth at an 8.67% discount rate. Now that's the key, folks. Let me bold this number, okay, 867. And actually I'm going to change the color so everybody sees it a little better. Let's make it yellow right there. Hold on, 867. Or that's not yellow, that's gray. Let me go yellow. We'll do this green. Okay? So 867. Now I want you guys to think about something here. If you know as well as I do, what's wrong with this number? Well, this number, 8.67, is what I showed you it should be pricing at in an ideal world. 8.67. Because the risk-free rate, this number here, productivity rate, is what has been the U.S. average for probably 70 to 100 years. It's been, about 3.3%. Inflation, based on 10-year Treasury, is 1.25. And then the equity risk premium over time is 3%. But we're not pricing with the risk-free rate premium of 3.3%. We just aren't. That's just the reality. So what are we pricing at? I would say that right now the risk-free rate might actually be negative, but let's assume that we take this number, down to, we're only going to have 2% productivity per year. That's it, going forward. The 3.3 is long gone. So then if it's 2% versus, versus 3.3, that means that the discount rate for this should be, should be the risk-free rate plus inflation plus equity risk premium. That's what it should be. So the discount rate should be 6.25%. So if you make 6% on your money for the next 7 years, and that's what you're willing to make because the banks are only paying 1%. 10-year treasuries, we can see, are only, you can look here, you can see firsthand. You don't have to take my word for it. I'm going to show you guys. I like showing everybody this stuff because sometimes people are like, how are you coming up with this stuff? So here's what I would say. You could go to CNBC and you can see right here that the 10-year Treasury is 1.3% right there. So the 10-year Treasury, UST 10Y, is the 10-year Treasury. So if the 10-year Treasuries are yielding 1.3, not 1.25, and then equity risk premium historically is 3% on the low side, 6% on the high side, and risk-free productivity rate number is 2%, then a 6.3% discount rate would mean that the S&P should be $4,937. Okay, that's what it should be selling at if you believe in these numbers. Okay, so where is the S&P at? Let's take a look. S&P 500 is $4,528. So you say, well, Bobby, this is saying, what your model is saying is it can go up another $400, $410. So then, what it comes down to is, what do you think you should be paid for your money? Right? That's the big question. How much do you think you should be paid for your money? Now, if you believe that inflation is misstated, or if you believe that the Federal Reserve is going to target 2% inflation, which they have told the world, folks, they're going to try to target 2% annualized inflation. So we're going to change this 1.3 number right here. We're going to change it to 2. And look at that. What's the S&P at, folks? 440427. So that's what it is if you use a 7% discount rate. Okay? So 440427. So if the S&P 500, we just looked at it, was 4528, then this model would say right now the market could fall 1% on the or 2.73% on the S&P 500. That's what that is saying. And that's assuming that you think this is a proper discount rate. Now, what you and I would argue about is, should the growth rate be 10%? That's a legitimate argument. So you got to remember, all this is a bunch of moving parts. You have to be like, okay, it's like turning dials on the economy. Okay, I'm going to accept this number. The Fed is saying this number. I think productivity is this number. But you might be like, you know what, Bobby, I want to get paid 4%. All of a sudden, the market's 16% overvalued. If you're really worried, you might say, you know what, I want 5%. Then the market's 26% overvalued. So this is the way this works, folks. You have to ask yourself, what do you want to bet on? Like which variables? And what I would say is my job, because I manage money professionally for people, I have to make sense of, okay, well, what is being said and what is actually coming to fruition in the stock market with these companies, with these various industries, and then how does that compare to the stock market? Now, if you told me, this company, like the S&P 500, it traded down to a 0% equity risk premium, and all of a sudden it was worth $8,000, right? This kind of happened back with the QQQ. You don't believe me? We'll pull it up. Okay, so let's assume that market just went up 60% from here. So if you went to the QQQ, which is the NASDAQ, and we go back to back here, you can see back in 1999, the NASDAQ, it went from 52, it shot up to 118 in less than a year, I think, and before it cratered to 21 2 years later. So 115 down to 22. And now it's at 380, right? So my point is, this stuff is fluid, and you have to decide on where do you want to be in the structure. So the approach that I take is I say, look, I don't know, like right now the S&P doesn't look super overvalued. If you believe it's going to grow at that rate. So the question becomes, Bobby, if the economy is growing at 5 to 7%, why is the growth rate at 10% for the S&P? That's a really good question. And what I would say is, historically, whatever the growth rate of the economy is, corporate profits tend to grow by about 2 to 3x that number. So if the economy is growing at 2 or 3%, then the growth rate of a particular company, if it knows what it's doing with positive operating leverage, should grow at about 2 to 3 times that number. So 3% growth, 6 to 9%. That's the way the numbers work out. So right now, because there's so much liquidity with the Fed, with fiscal spending is very liquid. The Federal Reserve with money. This is the deal with with why things are pricing the way they are. So I try not to get too concerned about it. Instead I'm focusing on what can I find that is really cheap or unloved right now, that knows how to make money. Which companies know how to make money, and then focus on finding those companies that know how to make money over time, that have strong book values, have good dividend payment histories. They might be in an industry that's unloved, right? Where right now people don't see, it's not exciting. There's no action going on. And if you put together a portfolio of these types of names, I happen to be a little bit of a contrarian investor. I don't like to chase The companies that you buy using that process, if you're right on the management team and you're right on, underpaying with regards to the valuation, and you come up with a good normalized earnings base, you tend to do pretty well. And so that's the way I'm dealing with the market probably being fairly priced. The press for over a year has been scaring everybody out of the stock market. We've all seen it, and it's been a little volatile at times. But I don't. I want to stress that the stock market's worth right now probably about $45 to $50 trillion in the U.S. So that's 45 million millions. Okay, 45 million millions, 45 to 50 million millions, because there's so much money on the line in this country, and in the U.S. markets. I do think that we're not going to, when I say the collective we, the investors of the United States, are not going to be too cool about things getting too out of kilter. Now, it's a tough thing to say, right? Because we see the government is going out of kilter with a bunch of things right now across various states. And I don't want to go into that because, if I start talking politics, they might ban me on this station. But it's a fine line, because we see the madness in the political process that's taking place, but then there's the economic process, and you have to pick your battles. You have to be like, okay, I know this is happening, but I still need to just look at what's really happening with the numbers, and then make adjustments if something is starting to impact the numbers when you see it kind of trickle in across companies and industries. So I hope that was helpful, folks. My advice is, if you don't know what to do, try to find somebody who you believe in how they do what their process is, how they invest. Make sure that they've been doing it. If I had a couple of things I would look at, I would be like, how long have they been doing it? Do they really know what they're doing in terms of how to value things, if they have the training and so forth? And do they have the temperament? Will they get shaken out, or will they stay the course and they know how to keep their head if everybody else is getting nervous? Because we live in that kind of time right now. We don't know. You have to be able to adjust to the news flow and what's happening. Otherwise, I do think you can do a lot of damage to your wealth. You might sell out at the worst possible time. If things are a temporary blip, or you might just stay on the sidelines for a year, which some people have done, and lost, the entire move up, right? There's some people that might have sold out last April, entirely. Can you imagine that? If you sold out everything at last April, I don't even want to look at it, but I'll tell somebody some bad news. If you were really scared and you listen to the corrupt media, which they are corrupt, I'm not gonna hide that fact. Everybody knows they're corrupt. I think 35%. I think the number is now 35% trust factor for the media in this country, down from 70% in a year. I think definitely for conservatives, but it might be for the overall country. But if you go back, to last year's lows, the S&P was 228. It's at 452. So you lost almost half your money, right? You missed 100% move up if you got out. 100%. So now for you to feel like you made the right decision, you got to have stocks fall 50% to get back in. So it's sad. I mean, I deal with this for a living, and I try to explain to people, look, it's important to be cautious. It's important to be wary, but you also have to live, you have to look at what's happening and realize that maybe things all don't, maybe everything doesn't collapse. And if it doesn't collapse, are you prepared for that world too? But I think you should be cautious, and you set the allocation accordingly. So if you want to preserve a certain amount of money, so if things do get really dicey, you know what to do. But if things don't get dicey, you don't want to get hammered either, right? So it's a tough thing, right? Because nobody has a crystal ball, and you just got to we got to do the best we can with the information. So that's what I would say. So my attitude is, own real assets, own companies, that is, individual names versus index funds and mutual funds. That's what I believe in. And, try to put together a good portfolio of names that you think have the staying power. And if you do that, I don't think you can be too badly hurt than if you try to get in and out of the market and time it. I think that could be very devastating to your wealth if you're on the wrong side of the flip, if that makes any sense. So hope you guys have a wonderful day. Thank you for chiming in. Be sure to like the channel. I'm such a marketer now. No, I'm saying is please like the channel if you want to be notified of whenever I do these broadcasts, and feel free to share the clip with other family and friends if you think it might be helpful. So God bless. Have a wonderful afternoon. Thank you.